Hey everyone, in this video I'm going to bring you one growth stock that's down 80% off its high that I think makes a spectacular investment for 2024 and beyond. This growth stock has actually gotten interest recently as a potential buyout target that has lifted the stock price higher by double digits, but it's still down over 80% off its high. So let's take a look at what this stock is and why I like it so much.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the growth stock that I'm talking about here is DocuSign. DocuSign is down 80% off its high, and you could see in recent weeks the stock has jumped following an excellent earnings update for investors. The week after that, or a couple of days after that, there was rumors that DocuSign was looking to make a sale or to be acquired. And so the combination of those two factors has really lifted DocuSign's stock price higher, but it's still down considerably off its high. And in fact, it's down for 2023 as well. And that's a little bit surprising to me because the company has demonstrated excellent revenue growth over the years, growing from less than 800 million in trailing 12-month revenue in 2018 all the way up to 2.7 billion in trailing 12-month revenue in the most recent update. Of course, DocuSign benefited tremendously during the pandemic when people did not want to get together in person to sign documents. Electronic signatures were incredibly popular. Now that economies have reopened, the demand for electronic signatures is not as strong as it was during the earlier stages of the pandemic. Still, longer term, electronic signatures are just so much more convenient than signing a document in person. The time and the hassle of going to meet in person just to put your signature on a couple of pieces of paper, it really seems like something that should have been done away with decades ago. But we're still doing that today. It seems like an industry that needs to evolve. I appreciate significantly when I can sign a document electronically and I don't have to go in person to make these signatures. The downside with DocuSign, the longer term potential, the industry, the electronic signature industry, it's not a massive market. Total addressable market revenue, even at its peak, is likely to be less than $100 billion. There's just not that much of a market for offering the electronic signature services. And so, even though it's going to grow for the next few years and maybe the next couple of decades, the ceiling is not quite that high. And couple that with the competition that's potentially ripe for entering the industry, you can understand why investors have not been too enthusiastic about DocuSign stock. The company has demonstrated excellent performance, demonstrating economies in scale. Economies in scale is one of the most desirable characteristics you can find in an investment. In the example I have created here, sales grow from 100 in year 1 to $115.76 in year 4, while net income more than doubles from $4.50 to $9.47 in year 4. This company demonstrates economies in scale. As its revenue grows, its profits grow by a larger magnitude. Not every company can achieve this kind of effective growth. Here's how it works. This is a typical categorization of an income statement of a publicly traded company. Cost of goods sold is what's called a variable expense. That means cost of goods sold is connected to sales. Other expenses like interest, general and admin, and depreciation are not connected to sales. You can see here depreciation stays the same at 25 whether sales increase or not. The same is true for interest expense. It stays the same whether sales grows or not. You can understand your interest payments do not increase when your sales increase. Overall, businesses typically have a mixture of fixed expenses that are unrelated to sales and variable expenses that are. When sales increase, the business leverages those fixed expenses, as we see in this example, and profits grow by a larger magnitude than the increase in sales. Showing you the operating profit margin in a trailing 12-month period of 1.92%, is up significantly from a low of negative 60%. So you can see it demonstrating the growth in revenue leading to an increase in profitability. Going forward, the prospects for DocuSign are solid for fiscal year 2024. The consensus estimate among analysts is for DocuSign to grow revenue by 5.7%, but for earnings per share growth to be flat. Operating profit growth is expected to come in at 4.7%. For fiscal year 2025, there's going to be an acceleration according to the consensus estimate, with revenue growth coming in at 7.6% and earnings per share growth of 8.8%, with operating income growth, in other words, EBIT growth, of 12.8%. So while 2024 might not be an explosive year for DocuSign, 2025 is expected to accelerate beyond that. And I mentioned that the industry, it's got a tailwind, right? Electronic signature is more convenient, and that tailwind is bringing demand industry-wide towards electronic signatures. Another thing I love about DocuSign is the company's ability to generate cash flow from their sales. 31.22% cash flow from operations to sales. And look at this figure increase from less than 16% in 2019 all the way up to 31% and moving in the right direction over the years. I like what I'm seeing in this metric from DocuSign, in addition to all of the other metrics that we've seen so far. The balance sheet is solid for DocuSign. $1.59 billion in cash and short-term investments and $689 million in long-term debt. When this is out of balance like this, it means the company can use its cash and pay off its $689 million in long-term debt and still have nearly $800 million in cash on hand. So the long-term debt is not an issue. It's not a risk. If the company wants to, it can pay it off in one decision if it wants to. It doesn't need to, but it can if it wants to. And finally, DocuSign stock is not prohibitively expensive, trading at a forward price to earnings of 21.44. The stock was cheaper for the better part of October, reaching down here near 14 a forward PE. But since the last few weeks, the stock price has jumped because of an excellent earnings report and rumors of an acquisition that has boosted DocuSign's stock price higher. Still, even at this valuation, I think DocuSign stock is a bargain for 2024 because it's not just that the company has demonstrated excellent growth in the past. The company, as I showed you already, it's expected to grow again in 2024, low single digits, mid single digits, but then the growth is expected to accelerate in 2025 with operating income growth of 13% expected in 2025. And the business model itself is light in its asset investing. You don't need to invest in physical infrastructure and all that for DocuSign to offer its services. It just needs to invest in the technology and incrementally improve the technology and the features to make it meet customer needs. So there isn't a lot of need for these profits to go back into the business, meaning the company can throw off a lot of cash and use it for share buybacks or dividends sooner than might be expected for a company of its life cycle. So for all those reasons, I think DocuSign is an excellent stock to buy for 2024. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.